Hi, this is Christy Wellborn, and you're listening to Estes Park Radio.com. Time for your weekly financial focus report with Jane Schoen from Edward Jones. Good morning. Thanks for being here. And today's focus, try to avoid these scary investment moves.
Thanks, Christy. If you have kids, or even if you don't, you probably are aware that Halloween is fast approaching. Of course, you may find that the ghouls, the witches, and the creepy impersonations of celebrities to be more amusing than alarming. But as you go through life, you will find some things that are generally frightening, such as investment moves that are misdirected or go awry. There are some potentially scary investment moves to avoid. First of all, investing too aggressively. In the investment world, here's one of the fundamental truths. The greater the risk, the greater the potential reward. So by investing aggressively, you can potentially achieve greater returns. But if you invest too aggressively, you can quite simply get burned and lose your principal. Another common step to avoid is investing too conservatively. You can't invest with no risk. However, you can find investments that offer a higher preservation of principal in exchange for little or no growth potential. But if your portfolio is full of these vehicles, you may never achieve the growth you need to reach your long-term goals. Third, failing to diversify. If your portfolio mostly consists of the same type of investment and a downturn hurts that particular class of assets, you'll take a big hit. But by spreading your dollars among an array of investments, you can reduce the effects of volatility on your overall holdings. Keep in mind, though, that diversification can't guarantee a profit or protect against a loss. Another highly risky move is to chase hot investments. By the time you hear about a hot investment, it will probably already be cooling off. And whether it's hot or not, it might not be appropriate for your individual needs and risk tolerance. Also, trading too frequently. If you're constantly buying and selling investments to maximize your profits, you may end up actually minimizing your success. Frequent trading will run up commissions and other investment costs, and the greater your expenses, the lower your real rate of return. Plus, by always adding and subtracting investments to your portfolio, you'll find it difficult to follow the type of long-term, consistent, comprehensive strategy that's necessary to help you attain your objectives, such as saving for retirement. Another caution, starting too late. As an investor, you'll find that time is one of your greatest allies. The earlier you start saving and investing for your goals, the better your chances of attaining them. Save early and save often may sound like a cliche, but it's good advice. Finally, taking a time out from investing. Whether it's a market slump, a political trauma, a natural disaster, or some other event, you can always find a reason to head to the investment sidelines for a while until things cool off, straighten out, or return to what seems like normal. Depending on your goals, not participating in the market may cause you to miss out on any opportunities that the market can present. At times, it can be tough to stay invested, but over the long run, a steady, disciplined approach can be a good strategy.
Well, Jane, now any quick ideas about how to stay relatively calm in the midst of market volatility?
First of all, it's not easy.
No.
We certainly have experienced plenty of market volatility over the last 6 weeks, and even go back a little farther since May 1st this year. It's not easy. I think selecting a strategy that matches your tolerance for volatility is probably the most important step. If you are overly aggressive, it is very difficult to stay true to your investment strategy. So it's important to understand what your tolerance for volatility really is. In good times, we tend to be more aggressive. In bad times, we tend to be more conservative. And truthfully, most of us are somewhere in between those extremes. And then, secondly, I would say work with someone. Find yourself someone to work with that coaches you. And when times are difficult, they will help you stay the course. Because for most of us, we need someone out there to say, you are doing the right thing.
We sure do.
So those would be the two things I'd recommend.
Okay. Well, Jane, how can people get in touch with you?
You can reach us at 586-9078 or stop by the Edward Jones office in the Upper Stanley Village. If you are looking for more details or would like to review the content of this conversation, you can find it archived dated October 24th under Try to Avoid These Scary Investment Moves.
Okay, Jane. Well, thanks so much for being with us.
Thank you, Christy.
This has been the Weekly Financial Focus Report with Jane Schoen at Edward Jones, and you're listening to Estes Park Radio.com. I'm Christy Wellborn.